Hello, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, November 10th, 2025. Today happens to be the 41st day of the U.S. government shutdown, and the shutdown may be coming to an end. There's hopes of that today, and we've seen that in the stock market, certainly with the NASDAQ elevated today. All indexes on the equity side pretty much up, so we may be near the end of it, but the impact for us as we discuss economic data is the fact that we do not have a full palette of information, and going forward, we're not sure when the blanks will be filled in, but we'll just work with what we do have. So last week, in terms of economic activity that was released, that information that we use, the ISM Manufacturing and Services Index, those are both scaled at 50. So above means expansion, below 50 means contraction. So the manufacturing index, that has been bumping back and forth, a little over 50, a little under 50. So for the month of October, the expectation, or the prior month, it came in at 48.7, and it improved a little bit closer to 50. It came in at 49.5. Now, conversely, services had held up so strong since the early days of COVID, in the mid-50s for the most part. Over the last year, it's dipped down to 50, and from time to time, a little bit under. So in the month of October, the index came in at a 50.8, which is awfully close. The prior month, it had been at 52.4. So it looks like services maybe a little bit weaker, manufacturing coming closer to being in parity between expansion and contraction. Now, labor markets, which is the big focus at this point, again, we don't have the BLS, Bureau of Labor Statistic number, non-farm payrolls or unemployment numbers to guide us at this point. So more focus has been put on the ADP employment change. It's a corporate survey, much smaller than the BLS, but nonetheless, it's the only real data point we have. That came out last Wednesday for the month of October. The expectation was that we had added in their survey 42,000 new jobs, came in at 25. All I can say about that is at least it was positive. And again, it's not the government number, so it's not terribly market moving. Lastly, last week, Friday, we did get the Michigan consumer sentiment. Now, this was a bit of a surprise. So for the month of October, that had fallen all the way down to 50.3. A year ago was close to 75, so it's been coming down dramatically over the last 12 months. However, for the month of November, surprisingly, it came in positive in that it rose to 53.2. So that's solid. The other numbers here, non-farm payrolls, again, not reported. Average hourly earnings, not reported. Unemployment rate, nothing. So that's all we have. In addition, the Atlanta Federal Reserve third quarter that ended September 30th, the GDP number has yet to be printed. We've mentioned many times Atlanta Federal Reserve, they're pretty good at this. They tell you during a given quarter and a little bit after what they expect for GDP growth, what they think it's running at for that given quarter. So for the third quarter, we were very surprised to see they started off close to 3%. GDP growth. That was coming off a 3.8% reported second quarter GDP growth number. So 3 sounded pretty strong. As the quarter's gone on, they've continued to take up their expectation, and now their most recent revision, they took it up one small notch further. So their expectation, third quarter GDP growth would be a very robust 4.0%. Inflation expectations, we mention this almost every week, but it hasn't been changing for quite a while. The 10-year expectation embedded within the 10-year break-even, 10-year Treasury, minus the inflation protected, is 2.28%, and it's been around 2.3 actually for the last couple of months. Fed funds, the expectation of another rate cut during the December Fed Open Market Committee meeting. The expectation is a probability built into the futures market now is 65% probability that we will get one and only one cut in December. That's down a little bit from the prior week. It was at 67, but 2/3 chance we will get one cut. Lastly, since we are focusing on only the information that we are getting, so much that we're not, corporate earnings have definitely been a huge focus, and we keep mentioning, and you'll see stock market last week, not great, but year to date has done really well. It's because of corporate earnings. The picture, there's some limits to this, obviously, but it has been really good. So the S&P 500 through the end of the day Friday, 91% had reported. Out of that 91%, 82% of them beat their estimates. That's far better than the 5 and 10-year averages of beats. The magnitude of beat for those 82%, I think I mentioned last week, it's only about 5%, so it was really below the 5 and the 10-year average. That came up last week because the beats were so significant, impressive, that now it's 7% is the average beat out of those 82% that beat, which is right at the 10-year average. So the earnings continue strong. So the expectation coming into the quarter, before companies reported the third quarter earnings, consensus was S&P earnings growth year over year, 7.9%. Companies have reported it keeps looking better and better. So a week ago, that had risen expectation to 10.7%. After last week's beats, which again was very impressive, the expectation is now 13.1% year over year growth. So with all that good news, how did the markets respond last week? Equity, not great. U.S. S&P 500 was down 1.6%. Now it's been a great year to date. It's up 15.6%, but certainly gave it back last week. And the culprit, usually if it's up or down, Magnificent Seven. Last week, Magnificent Seven collectively down. If you equal weight them, an index that we just keep track of for our own use, was down 3.3%. So that drove the S&P down last week, again down 1.6%. In a reversal that we haven't seen much this year, the equal weighted S&P 500, which equal weights all 500 of the companies, so it takes away that huge impact for those Mag 7s. That index was barely negative. It's minus 0.2% for the week. In terms of international equity, again, international, both developed market, ex-US, and emerging markets have outperformed the S&P 500 year to date. Both were down last week. Developed ex-US down about 90 basis points. Emerging markets down 1.4. But again, for the full year, the numbers are pretty impressive. Developed ex-US up over 25%. And emerging markets in total up 31% year to date. Fixed income last week was, I'll just call it flat. 2-year was down a basis point. 10-year was up 2 basis points. So the Bloomberg U.S. Aggregate Index up 3 basis points for the week, but the big takeaway, simply the year to date, so strong, positive 6.82%. So economic activity coming up this week, and actually we do have some, so it's a pleasant surprise. On Thursday, we're going to get CPI and core CPI. Those are both for October, and they're both expected to be slightly better than what we had in September. So September CPI was up 0.3%. Consensus is it will be up only 0.2%. And core CPI, CPI less food and energy, was positive 0.2% in September. It's expected to be positive 0.3%. So on Friday, we'll get PPI, core PPI, retail sales, and retail sales ex-auto. We didn't actually get September numbers, so we're not even sure we'll get these numbers. We may not. But the expectation is, at least the consensus, is PPI higher than CPI. The expectation is 0.4% up month over month, and then core PPI positive 0.3% month over month. Same thing for retail sales and retail sales ex-auto, expected to be up 0.3%. But again, given we haven't had any numbers released, we're not even sure what we're shooting at. Well, that's it. Thank you very much for your attendance. We'll look forward to seeing you next week for another weekly economic update. Thank you so much for attending.